Hi, everyone.
Hey,
Welcome. Adam, we
um,
just have to unmute you, but while everyone's joining in and clicking through, as I see Adam shifting on the screen. Welcome everyone to our Clark Capital quarterly update on what's going on in the world today. So as you're joining, and we'll let everyone kind of click through, but we have obviously Adam and myself and the infamous Glenn Dorsey, who is on the screen. He has a bunch of information he wants to go through. I was talking to a lot of our clients so far at the start of the year that to me, all of Glenn's webinars are important, but this is the beginning of the year. This is February 2026. What are we looking for? What are we expecting? What is everyone talking about? So I'll pass it over to Glenn. Certainly, there'll be opportunities to ask questions, whether to the chat or the Q&A. So we'll make sure to address it that way as well. But feel free to jump in, and Glenn, I pass it to you.
great. Thank you, Jill. Good afternoon, everybody. Thank you for joining. The most important update just got texted to me. The U.S. women's hockey team won the gold against Canada in overtime. So go USA. Um, if you watch the news, it feels like the world's coming to an end. It sounds like this nonstop barrage of bad news, and we were talking about how much the stocks were down, and we were down 2.5% from the all-time high that we hit at the end of January, January 27th. You would think we were in this 3-year bear market when you look at the news. So what I want to do is refocus on what's actually going on, what we're expecting to happen, and just stick to the fundamentals. As many of you know, if you've ever seen any of these, we try to distill everything down into what actually makes the market move. And the most important thing that makes the market move is how much money companies are making. Very simple. If you have a business and it makes more money, it will go up in value. If you have a business and it makes less money, it will go down in value. And some of the things that influence that, or the multiple that people will pay for those earnings, are captured by these five gauges. And the basic idea is if it's straight up and down or at 12 o'clock, it's neutral. To the right, it's good. To the left is bad. So the economy is actually getting stronger. We heard all the talk. We were going to have a recession. The tariffs were going to throw us into maybe a depression. We heard all of this stuff. None of it's come to pass. The third quarter GDP came in at a 4.3% after inflation growth rate. That's stronger than you would expect in normal times. Earnings have been particularly strong. The last 5 quarters that the S&P 500 companies have reported, earnings have grown by more than 10%. That's really strong growth. And the consumer, we hear all about, the K-shaped economy and the consumer's over leveraged, and how bad consumer sentiment is. That's all true, and everybody continues to buy stuff. And the U.S. consumer is roughly 70% of the economy, so that's really important. So this gauge, we'd actually improved from the last quarter to not all the way full positive, but pretty fully positive. The Atlanta Federal Reserve tracks all of the monthly data, and they try to estimate what the next quarter GDP growth is going to be. And so for the fourth quarter, which will be reported tomorrow, they're actually estimating up 3%. Now, all the numbers were delayed again because we had the partial government shutdown. We had the full government shutdown before, and then we had a partial one, so some numbers got delayed. But inflation continues to drift down. CPI, Consumer Price Index, is down to 2.4% inflation. That's pretty solid. We were up over 9 at the worst part back in the summer of 2022. So we think that's continuing to drift ahead the right way. And I'll get into more detail on all of these in a bit. Monetary policies, the Federal Reserve. Quite simply, when the Federal Reserve is cutting rates, the market tends to do well. There's an old expression, "Don't fight the Fed," and we had the equivalent of 4 rate cuts at the end of 2024. We had three more at the end of 2025, and we expect some more this year as well. So besides strong economy and strong earnings growth, we have a Fed that's giving us a little bit of a tailwind. Um, the one area that we had in slight negative territory is valuations. And what do I mean by that? Well, if you were going to buy a business before you decided how much you were willing to pay, which is the price, you'd want to know how much it's making. Makes sense, right? We do the same thing. So by historical measures, the stock market's kind of looks a little expensive when you look at it overall, but that's because there's a handful of really big companies. You might have heard of all the Magnificent Seven companies out there that are growing earnings very quickly. So they're trading at a multiple or a PE multiple that is higher than historic averages. With a recent pullback in that group, if we were to redo this gauge today, we'd actually move it back into neutral territory. And what we find is that this is, oddly, you think this would be the most important gauge. This is probably the least important gauge for the direction of the market because it can stay one notch left or one notch right for a prolonged period of time. When I say prolonged, I mean it could be years. So right now, valuations have come back in. There are opportunities in mid and small cap and even international stocks that are considerably cheaper than the S&P 500. They're growing, they're earning slower as well. But when you look around, you can still find some bargains out there. Investor sentiment is our most volatile gauge, and it just measures fear and greed amongst investors. Warren Buffett has a great expression. You want to be greedy when people are fearful, and you want to be fearful when people are greedy, meaning usually when you're scared, that's the time that you should be buying. And so what we saw is as the market was going up and hitting new highs in 2025, and then even four new highs in 2026, people started to get a little bit ahead of themselves, a little bit too optimistic. And with just a small pullback, we've seen fear levels go back up. So again, if we were to redo this gauge today, it would be back in neutral territory. Then lastly, interest rates, they've been going down. That's good. And importantly, short-term rates are lower than long-term rates. So when you connect those dots, we call that the yield curve. We like to see that sloping up. That means that the Fed is not trying to choke off the economy, which when they raised rates to cut or to bring inflation in, it looked like this. Short rates were much higher than long-term rates. That's usually not good for the stock market. And if you recall what stocks did in 2022, it wasn't good for the stock market. So there's a lot of words on here. I'm going to summarize this. Our year-end target for the S&P 500 is 7,700. So that would be up about 12.5% from where we ended the year. Just as wow, that's a really bad. I hope there's no teachers on here grading my penmanship. I'm doing this with a mouse and my handwriting is not that good to begin with. But our year-end target for last year was 6,700. We said we thought it could be beaten a little bit. We were pretty close. It came in at 6,845. So again, we're looking for earnings to increase and drive the market higher. Interest rates we expect to be kind of in a range that's drifting down, kind of like this. And right now we're sort of in the middle of that range. We're about at a little better than 4% on 10-year Treasury. Expect the economy to grow by 3% or so, and some additional Fed rate cuts, which will help propel the stock market, in our opinion, higher. It will not be a straight line, right? We've gotten spoiled. We've had 3 years in a row where the market's gone up in double digits. And we haven't really had that much volatility by historical measures. Last year was actually a pretty calm year, despite the little tariff tantrum that we had in April. Other than that, it was a pretty calm year. So we have a midterm election this year. Markets generally don't like that. I'll talk a little bit about that. And we'll have a new Fed chair in place, hopefully in the middle of May. And the markets tend to get uneasy when there's change. So we would expect some additional volatility this year in what should be a good year because our companies are making more money. Just a quick look at what happened last year. If we could photocopy this, and do it every day for the rest of our lives, we'd be thrilled, right? The S&P was up almost 18%. The average stock up a little less than that, about 11.4%. Small cap companies started to come back at the end of the year, which was nice to see. And value stocks, which were outpaced by growth stocks, caught up quite a bit as well. So what we've seen is it went from 7 companies driving the market to a whole bunch of companies driving the market, and that's a much better, healthier rally. International was up over 32%, which was pretty spectacular, partly driven by the dollar going down, and even bonds across the board were up. Again, that's from our perspective about as good as it gets. Just remember that volatility is normal. You shouldn't be afraid of it. For us, it's an opportunity. We welcome volatility because it gives us the chance to buy companies that we wanted to own or want to own more of and get them at a better price, right? As long as their businesses are making more money, if the price goes down in the retail world, you'd call that a sale, right? I'm buying the same good or something better at a lower price. That's good. If earnings are going down and stock prices are going down, that's a totally different story. That's a problem. But on average, you get 3 pullbacks of 5% or more in the market, right? As I said, the one we just had was 2.5%, and the media went crazy like, the world was coming to an end. You get a 10% correction on average once a year. And, every 3 years, you get a 20% correction, right? Not telling you this to scare you. It's just the way the market works. It doesn't go in a straight line. Over time, the stock prices will follow earnings. In the short run, it follows emotion, right? If you get more sellers than buyers, the market goes down. It's pretty straightforward world, but that again creates opportunity. And a good example of that was the beginning part of last year, right? We had this. This was what happened up until the day before President Trump said he was only kidding about the tariffs and they were going to get postponed. So everything was down. The S&P was down 15%. Small caps were down over 20%. The only thing that did okay was international was down 3%. Growth stocks down 20%. Everybody wanted to jump ship then, right? It was going to be a recession. We were going to have the worst bear market we've ever seen. And this is what it did for the rest of the year. Right? So emotions are wonderful to have as a human being. They're a horrible thing to have as an investor, right? You got to stay focused on what actually matters, and that's earnings. So, taking a look I'll show you a couple of slides on the economy. So we had 4.3% growth in the third quarter. That was up from 3.8% growth. And for the fourth quarter, we're looking for about 3% growth. So, from a long-term standpoint, we're growing at or above what you would expect for a giant mature economy like the United States. So we're in pretty good place. Again, when you watch TV, it sounds like it's the worst economy we've ever had, and it's just not factually just not correct. I'm not playing politics. I'm just communicating what's actually going on in the world. And some things I say might make you think I'm a Democrat. Some things I say might make you think I'm a Republican. If that's the case, I'm doing my job. So I'm just actually showing what's happening. So there's there's a consumer sentiment survey that comes out, right? And people feel terrible, right? And they really do. And there's some good reason for that because, if you look at housing, healthcare, and energy prices have come down. But those are couple major things that affect people and affects lower income people more, right? If you spend $100 a month or $200 a month driving back and forth to work, it matters a lot more if you make $30,000 than if you make $300,000, right? It's a bigger portion of your paycheck. The same is true with heating your house and things like that. So people that are surveyed that say the world's coming to an end, and then you look at what they're actually spending, their world's not coming to an end. And it's particularly interesting when you look at I think where some of the money's being spent. It's on things like meals away from home, hospitality and leisure, travel. Like, okay, well, if you feel that bad about your financial well-being, why are you going out to dinner? That's what my parents would have said to me. I think people feel worse than they're acting. We call them grumpy consumers, basically. Everybody's a little grumpy. When you look at debt. We hear a lot about debt out there and the consumer's buried. So this is all household debt payments as a percentage of your take-home pay. So after you've paid your taxes. Now, is it up from where we were after the stimulus checks? Yes. But if you look at it relative to history, it's kind of a non-starter. It's not a big deal. We're at 11.25% of our take-home pay is going to pay for debt. If you break it down further and look at mortgages, even with rates having moved up recently, kind of in line with long-term averages, consumer debt, which would primarily be credit cards, same. Right again, so it doesn't look like the consumer's drowning in debt. That is important because they run out of things, ability to spend money. That was the case. Here's inflation. We talk about it. Still too high. It is, but now CPI, which is the green one, is down to 2.4%. Right, so it's continued to drift down for nearly or more than 3 years at this point. It's hard to believe, but it peaked in the summer of 2022. So we've been on a downward trend, and we think that will continue. So again, the media has to find something to get excited about. Every layoff that's announced, the media jumps on and talks about, this layoff happened, this layoff happened, and that's terrible. We're very sympathetic for that, but the unemployment rate's actually about 4.3%. It was as low as 3.4%, which is incredibly low. That's way beyond the norm. When I was in college back in the 1800s, they said that unemployment couldn't go below 5%. 1800s. That was a joke, Jill and Adam. I can't see. You're like, yeah, he was. He's that old. So they used to say unemployment couldn't go below 5% because there's frictional unemployment out there, people changing jobs, people moving. So at 4.3% is actually pretty good. The hiring rate has definitely slowed down, but this is from the layoffs and discharges. It's been flat at 1.1%. So it's kind of what it looks like, and it makes sense, is the companies have slowed down or frozen hiring to a degree, but they're not doing mass layoffs, right? And that's really important. If that ever starts to turn up significantly, we would be more concerned, but it's really been pretty solid. This is the take home, right? Here's how much money the S&P 500 had in earnings, the gold line, and the blue line is its price. So the really, really bad markets that everybody wanted to avoid, like the financial crisis, earnings disappeared. Same happened after when the tech bubble burst. It wasn't because valuations were too high that the market went down. It's because earnings started to go down first. Earnings started going down 2 quarters before stock prices started to go down back in the tech bubble. Everybody forgets that. And the Fed was raising rates, which was not good, right? And you could get 6.5% on a 10-year US Treasury. A lot of bad conditions back then that fed into that. Earnings were down 100% in the financial crisis. Stocks down 50%. You had milder versions in 2018, but what have we had basically post-COVID is a straight line up in earnings. In fact, the earnings estimates for this year are now up at about here, and for 2027, they're expected up there. Right? If our companies are going to continue to make more money, it's hard to envision a really bad bear market. We will have pullbacks. We will even have those 20% corrections, but we don't. You're not going to have one of those 50% drawdowns if earnings continue to move up. And here's a look at it, quarter by quarter. Again, this number, which was $263 expected for the end of 2025, came in at $273. Right? So companies did so much better than we expected, and these numbers continue to drift up. As long as we have this upwardly sloping trajectory of earnings, we feel good. Right? That's when we're in the buying mode. Monetary policies, the Federal Reserve. Again, the Fed has been cutting rates. We can actually look at what the financial markets are expecting. And this was as of the beginning of the year. It's actually shifted a little bit so that the market actually thinks there'll be somewhere between 2 and 3 cuts this year. first one being in June. Right. So, we'll have a meeting in March. We're not expecting a rate cut there, but we do expect more cuts later in the year. And they're taking their time because the economy is okay. They don't need to stimulate the economy a lot. It's because it's doing just fine on its own. And in fact, when you look, it's probably hard to see, but when the Fed is cutting rates slowly, the stock market 1 year after that is up 24%. When it's cutting rates quickly, it's actually only up 6%. So we want to see the Federal Reserve going slowly. If they're going quickly and doing a lot, it's because the economy is starting to fall apart, and we don't want that. Stocks will not like that. Valuations. So I talked about the Magnificent Seven stocks. They're the Apples, the Amazons, Tesla, Microsoft, all the names that you hear over and over again. So Magnificent Seven stocks. So they're trading more expensively. Now, this was as of January 21st. If you look today, actually, this multiple is down about here because some of those stocks have come down. At the same time, their earnings have continued to go up, right? So that's actually good. We kind of like to see that valuation do a little bit better. The S&P 500 is right now about 21 times, so that multiple's come down a little bit as well. And then what we do is we look at the S&P excluding the seven biggest companies, which makes it the S&P 493, and that's even cheaper. We're at about 20 times earnings. So stocks aren't cheap, but they're not wildly overvalued. Now take a look at, interestingly, to show you, when I remember I said the valuation is probably one of the worst tools. Look when it looked really expensive, 2020. That was a great time to buy, right? As coming off of COVID. So you need to focus on not just what you're paying, but what you're getting. And what we got is a tremendous amount of earnings growth since that time period. And then when you look at the big companies, as I mentioned, S&P 500 is up here. But then when you look at mid cap and small cap, it's a lot cheaper, right? So and at the same time, the earnings growth is starting to pick up there. So that's a good combination. And here you can take a look at the earnings growth for large companies. So this is pegged back to 2010. And then mid-size and small companies' earnings have actually grown faster over that time period. But here, this period, they weren't, right? So you see the red line sloping up there. So earnings were accelerating for the big companies, and they really weren't for the small and mid. But now that's changed, right? So now you're starting to see that earnings growth gap shrink, and that's why you're starting to see the small and mid cap companies do better. And then the simplest thing I mentioned, if you're going to buy a business, you figure out the price based upon how much it's going to make. But one other factor would make sense too, right? If you're buying a business that's grown 3% a year for the last 20 years, and then you had another business that grew 20% a year for the last 20 years, you'd be willing to pay a little bit more for that company that's growing 20%, right? Makes sense. So what we do is we look at, all right, what are we paying for earnings, and then divide it by the growth. And they call that a PEG ratio in fancy CFA lingo terms. But what do we pay? What multiple are we paying and what growth are we getting? And by that measure, right, when you look at where we are today, it's hard to say that the market's expensive because earnings are growing that fast. And arguably we're relatively cheap compared to history by that measure. And then we look at international stocks, again, that same PE multiple, fair amount cheaper than the US, even though international did quite a bit better last year, but it underperformed the US for better part of a dozen years. So we're playing a little bit of catch up there as well. Investor sentiment. So again, we're trying to gauge investor fear and greed. Warren Buffett, who's got a couple. This is AI Warren Buffett. Pretty cool. Be greedy when people are fearful, and fearful when people are greedy, or otherwise buy low, sell high. Makes a lot of sense. The American Association of Individual Investors puts out a weekly survey and they ask non-professional investors, will the market be up or down in 6 months? So what we saw most of last year is that there were more negative people than positive people. Towards the beginning of this year, though, we got to a point where almost half the people surveyed thought the market was going to go up. That's why we had that gauge in negative territory. If you look at last week's reading of this was back to 38, and this was at 38. You had a balance basically between bulls and bears. So that's why I said if we were to redo that gauge today, we'd probably have it in neutral territory instead of negative. So it's amazingly good because the average person that's surveyed has an incredibly good track record of being flat wrong. So April 2nd of 2025, which was right before the market bottomed, 62% of the people surveyed said the market was going to keep going down. And guess what? That was like a really good buying opportunity. And then the other thing that's kind of interesting is that the money market balances have continued to just shoot up. People have been afraid to get into the market. So that tells us, surveys say one thing, but then actions say another. There's a lot of money on the sidelines. About $7.7 trillion in money market that is going to see rates continue to move down as the Federal Reserve cuts rates. So at some point, that money is going to want to come and find more attractive returns, and that'll be an interesting sign. And then lastly, interest rates. So, everybody talks about interest rates like they're one thing. The Federal Reserve lowered interest rates. Well, the Federal Reserve controls what's called the federal funds rate, which is overnight lending, right? Very, very short term. So takes a look at where we were at the beginning of last year and says, okay, what was a 1 month Treasury bill paying? What was a 2 month paying? What was a 2 year paying, and then all the way out to a 30 year, right? And then we plot that, and we call that the yield curve. As the Federal Reserve lowered rates, they lowered rates by 0.75% last year. What did short rates do? They went down by about 0.75%, right? Not all interest rates went down. And as a matter of fact, when you went further out, some of the longer maturities, the yield actually went up. That's why you haven't seen mortgage rates decline as much as the Fed has cut rates. And that's not an unusual thing. This pattern is very normal. And we talk about this all the time. So when we're managing the bond portfolios, we're basically focused here. This is our sweet spot. And we benefit from rates coming down, but we don't have all the interest rate risk of going all the way out to 20 or 30 years in the portfolio. And it worked out really well last year for us. And then I will show my disclosures because this is recorded and my compliance department will review it and make sure I didn't say anything bad. And there are all our descriptions. And I will stop sharing my screen and invite Adam and Jill and Michelle to come on. And there's a chat feature or that you can chat in questions to us, or there's a Q&A box too that you can send in questions that I think you're not able to mute yourselves. Forefront folks, anything? Can you not unmute? There we go. Now you can unmute.
All right. Hey all, Jill, I'll let you go first since you kicked it off.
So thank you, Glenn. That was amazing. And I started writing questions and I started crossing all of them off because you were answering so many of them. I wanted just to go back to the Fed. You briefly mentioned the new Fed chair because, as you say, everyone watches the news, even though I know you and Clark say don't turn on the news unless you have to. And there's never a reason to turn on the news. But they are talking about the new Fed chair that's coming in. And obviously the market doesn't like change. How are you? How is Clark? How are we looking at that going forward? The market liked Powell, the one who's supposed to be in. What are the feelings? I know there were a couple of people, and I forgot the names, so I apologize. I didn't write them down. But there was one gentleman that the market was like, nope, this is a big no-no. If this happens, if he gets in, it's going to be horrible. But it seems so far the market's okay with who's touted for this new role?
Yeah, that's a great and important question. So the Federal Reserve, I might even pull up another presentation that I just got approved as I'm talking. So the right now the appointee for to take over Chair Powell's spot is Kevin Warsh. He was painted as a originally painted as a hawk, meaning that he didn't like lower interest rates. He was a former Fed governor, and Frank was there during the financial crisis, so he's got a lot of experience. He's got a great resume, as a matter of fact. But what he didn't like is extreme Fed measures. He didn't like 0% interest rates for a prolonged period of time, and he didn't like quantitative easing, which is when the Federal Reserve goes in and buys up treasuries to artificially drive rates down. He didn't like that. And as he's clarified his position, which I don't think was an unreasonable position, now they're saying, oh, he's now dovish because he's getting appointed by Trump. But I think that's a really inaccurate way to describe him. But I think most people don't realize that it's not the chair that decides where rates are. It's actually a group of voters, right? So there's a board of governors, right, that are permanent voting members, right? There's 7 people on there. Those are the people that get appointed. The New York Fed president has a vote, and then there are 12 regional central banks, and 4 of them are on at any one time, and it rotates. This January, 4 of these people changed that were on there. So we have a new Fed chair that's coming on in May. We have 4 new voters that came on, 2 of which seem to favor higher rates. One seems to favor lower rates, and one seems to be neutralish, right? So it's going to be a very interesting Fed, and even if Kevin Warsh is quote unquote, Trump's puppet, as they're saying, he's going to have a tough time convincing other people to lower rates. I don't think that's what his agenda is. I've always said, being a cynical Northeasterner, if you want to figure out what people are going to do, you have to figure out what motivates them. Nobody takes that job for the paycheck. They make a lot more money in private sector, so this is an ego thing. If you want to flatter your own ego, you want to do the best job you possibly can, so you look amazing. You don't want to be known as the person that just followed directions from somebody and then caused, runaway inflation. So I think people that take that spot are well-intentioned in terms of what they want to get done.
I think that was a great slide because that's the point. Everyone's like, it's just Powell. They don't realize the behind the scenes, or most people don't realize it. So thank you for showing that. We did have a question pop up. 60-40. So everyone's been talking 60-40, 60-40, 60-40, 60-40. Do you feel that 60-40 is the right way based on, you went through all those amazing slides. Do you think 60-40 is the ideal situation for the average investor? What are your thoughts?
Yeah, it really, really comes down to what your personal circumstances are, first and foremost, right? And it also depends on your personality. If you go by pure math, say, okay, I want to maximize my return over time. Over time, you're 100% stocks. If you want to maximize your ability to sleep at night, you're 100% bonds. So you need to find the middle ground of what am I trying to accomplish? Where's this money going? How much up and down can I take, right? Because with that extra return that stocks have given over time, they give you a lot more blood pressure spikes. So ultimately, I think of it this way. What we're all trying to create is a pool of money that's going to create a distribution stream to us when we need it. And what we want to do is try to keep that pool of money going higher because inflation is going to eat into things and costs are going up and life just becomes more expensive. So we don't want the pool to just go stagnant because then it'll start to go into a downward spiral, right? So we want to continue to make that grow, but we don't want it to be super volatile, right? We can take that when we're 21. We can't take that when we're, getting more mature, let's say.
Good choice of words.
I changed my number 3 times in my head. I was going to pick on Adam, and then I decided to just go generic. So what's interesting, if you look at it, endowments and foundations, and we've managed a bunch of those over time, they're designed to pay out 3 to 5% a year and never to go to zero. Right? And if you look at how the average allocation of whether they are, they're usually somewhere between 60 and 70% in equity, and the balance in bonds and things like that. So it's a pretty good rule of thumb that you're capturing a good part of the upside of the market and you're narrowing a lot of the volatility of it. But I can't say that it's perfect for everybody because it really comes down to individual circumstances.
Yeah, and Jill and Glenn, I'd jump in from the 60/40. Interesting topic because I think it's a headline or people just writing in articles, and that's what general public look at and say, oh, this is good or this is bad. The thesis behind is 60/40 dead, which is the articles that you see plastered all over the place. One of it is, well, those are kind of target investor type of portfolios are just put out there. 60/40 was what you should be doing from an academia standpoint. None of our clients, and we have a lot of clients that came from academia, but none of our clients and how we build portfolios for each and every client is custom based on their circumstances, based on their personality, and based on their personality of their money. And when I say personality of their money, the purpose of their money, we have some clients that are north of 70 that have parts of their portfolio 100% equity because the money is not for them. The money is for the next generation. We have clients that are in their 20s and 30s and their parts of their portfolio are 100% bonds because they can't afford the volatility because that money is earmarked for something to be used in the next 1, 2, 3, 4, 5 years. Where this comes, so for all the clients that are on here and for when they hear this later, every single client is handled individually. And the portfolio ratio is very important. That's why we at Forefront ask so many questions and then always circle back to see how you're doing, what's going on. It's not about the markets. It's about when are you going to be using the money, what's the purpose of the money, and what's the time frame of the money. And then from there, we still double and triple down so that we know what type of allocation to be, so that you have the 60/40, 70/30, 80/20, whatever that is, that's per person. We don't have a mantra at all of this is how we manage every single client's money. Part B of this is, which was just validated at the last conference we were all at from other firms, that I think the real question is debt or bonds a bad investment? And they're not anymore. And they were never really a bad investment. They just weren't performing as well because of quantitative easing, because of the amount of funds that had flown in to the market, which depressed the yields of bonds and depressed the returns on bonds for a short period of time. But Glenn, I mean, that's what, this is what you were talking about before. The yields on bonds are back because everything's normalized there.
Yeah, if you went back towards the end of 2020, the 10-year treasury got as low as a 0.5% return, right? So this is when the 60/40 dead came to light because bonds weren't doing anything, right? They were only there to provide an offset to the volatility of stocks. There was no return, and there was a term that came out. They said the stock market was going up because it was TINA. There is no alternative, meaning bonds were just not there. Well, now the 10-year treasury is over 4%, which means corporate bonds are at 5%, which means non-investment grade bonds are at almost 7%. Right? Now they can actually earn their return and they're in line with historical averages. So they're a meaningful contributor right now to the portfolios. You saw what returns were on there on the screen from 2025, the aggregate index was up over 7%. I'll take 7% with the volatility that you get with bonds, which is a lot lower than stocks. That's a nice number. So yeah, the 60/40 portfolio has died more times than Freddy Krueger, and it always seems to come back to life.
I'm going to switch topics because I actually love exactly how this is worded on the Q&A. Are we in an AI bubble, a baby bubble, a ready to burst bubble, or is it a lot of Hubble bubble? So I loved how that was phrased. So I'm going to throw that to you.
So AI is so significantly game changing, much like the tech revolution was in the 90s, but more profound. We're at the tip of the iceberg in terms of figuring out how much efficiency this is going to create. We have initiatives in our companies trying to figure out uh, how it can be used. So it's gone in cycles. We had the chip companies and the aggregators of all of this AI stuff went up a lot, right? And then kind of the next ring out was the data warehouses that have to be built for these things. So you're making money on companies that leveled the ground and built a data warehouse, the steel that went into it, and engineering, construction equipment, all these things have done really well because of the significant capital spending that's going on there, heating, cooling, electronics that go in there. The next level out is the users, right? And people are rightfully to some degree afraid of losing jobs, but I heard it put well. You're not going to lose your job to AI. You're going to lose your job to somebody else that's using AI, right? And it's a really good way to think about it. You know, I'm 62 and I'm learning something every day about what AI can do to make my life easier, not to replace me, but to help me gather all of this information, process it, it can help you put together a presentation. I haven't used it to do that yet, but I can assure you that I will, because that's not the best use of my time creating a presentation in PowerPoint. That's arguably not the best use of what my company's paying me to do. So I think it's incredibly exciting. I think you'll see that drives a sustained leg up of earnings. I think right now, the people that are just only looking at what the stock prices did and kind of missing the bigger picture are probably being pretty short-sighted about it. You want to be selective. You want to buy high quality companies, but many of these big names that they're so concerned about how much they're spending on their build out can pay for it from cash from their business. They're making so much money that they're reinvesting cash. They'll borrow money in the bond market because they can borrow it in many cases almost as cheap as the U.S. government for good reasons, right? So and you're not going to have a bubble in the market when earnings are going up, the Fed's lowering rates, right? And interest rates are remaining low. Those conditions are just generally not associated with a bursting of a bubble. You will have bursting of some stocks along the way. Yeah, we call them the meme stocks that go up by some ridiculous percentage and they literally have zero revenue. That's a gamble, right? That's not investing, that's gambling. Right? The companies have real businesses that are investing in what is an exciting area of growth over the long haul. That's going to look great. You'll have pockets of time where they look bad. They don't look great right now, right? So from October, they've kind of languished and gone down, but long-term prospects for these things actually are pretty encouraging.
And AI, going back to what Glenn's talking about, we're using AI behind the scenes with every meeting now for note taking, and it helps us just be better. It's being more intentional about what we're sending out, making sure that we can follow up with you. I know that all the firms are, we were just at a conference where AI is going to be now embedded in software and it just keeps coming out. And it's not to replace people, it's just to make everyone that much better, that much more in tune, so we can provide the customization that we do for all of our clients. And that's just in our industry. I'm just seeing this moving forward. And you take it in any industry, and it's going to make improvements, um, uh, exponential improvements. There's going to be some hiccups. Here's a hiccup that I'm seeing right now, that looking at who's on this call may not impact you, but it may impact family members, that I'm seeing. The job market. Glenn talked about the job market right before, and I know that there's a lot of people that are recent college graduates that are having a tough time finding jobs. I talk to business owners all the time, small business owners. Small business owners are having a tough time finding talent. So the connection is the AI algorithm in between. So for the large companies where a lot of these new recent graduates are trying to apply, all they're getting bounced back by AI because it's being screened and not answering questions correctly. The smaller companies just don't know how to really crack that code yet. So the industry that's really bouncing, and we found someone this way, I think is going to be more headhunters, really having that intermediary grouping of businesses where they will, it's like a dating app, right? We have to hire good people, but how do we find them and how do we mesh them together? Used to be you knew someone at company X and you can get them to company X and get them an interview. That still happens, but it's getting harder and harder to have that interaction because there's so many other layers in there. Point
And
being, AI needs to work its way out. AI needs to be incorporated in companies. But I am, based on the stats before, I don't see a job problem. I don't see an unemployment problem. I see that matching talent to companies and companies looking for talent has been a little bit more difficult. I know, Glenn, with your company, you share with me, you guys are about to hire another 30, 40 people. And of course, you're a bigger company than Forefront. But how are you guys attracting the people? Are you using headhunters or how are you doing it?
uh, some cases we're using headhunters, other we're using social media postings to have the job postings out there, and we get probably 50 applicants for every job opening. Um, so it's really interesting. The world is changing, but it's not necessarily getting worse.
Right.
There hasn't been an innovation in history that didn't create panic and chaos. Electricity, automation, automobile, airplanes, all of these things people had said, oh, the world's going to come to an end because of this and nobody's going to have a job anymore. And here we are with 168 million workers, right? And we've navigated, and then the internet was that we're going to put together a short video on what some of the newspaper articles then about how there were not going to be any jobs left in technology because of the internet, and there weren't going to be any jobs left anywhere because of the internet. And that just didn't play out, right? And I think that you're going to see a similar thing with AI. There's people are always nervous about change, and they rightfully should be. I think it's can make a lot of people's lives easier if you're in the workforce. You need to know it. It's a skill you need to know, just like had to learn how to use a computer. My brother's 10 years older than me. He was president of a bank, we were talking about technology 20 years ago. He's like, why would I need to learn how to, do this? I was like, because everybody else is learning and you're competing against them. That's why. And so that's kind of where it is with AI. If you're in a competitive work environment, don't let yourself fall behind the technology. Make it your friend, not your enemy.
Absolutely. And going through a couple of other points that Glenn went through his presentation, and just quickly for a matter of time. And please, if anyone has questions, put them into the Q&A or put them in the chat window. Um, I just wrote down, this may not be in any kind of hierarchical order, but inflation. I thought that was an interesting slide again. From a planning standpoint, we've always been taught, or I've always been taught, one of your slides actually, I'm like, wow, I am older now. Like, I actually lived that entire from 2000, because I got into business in 1998. And so that whole slide from 2000 to present, I was like, okay, yeah, I've lived all those slides. But back then and all the way through teaching and training, we've always been taught use a 3% inflation hedge on your plans. It was never 3%. It was way under 3%, but it was the average over since like the Depression was a 3% inflation. And then it was way below that.
Right.
Then we had quantitative easing and the money supply, which we won't go into today, which will be here for 3 hours, it just spiked inflation. And we had it twice since we had it in '08, and then we had it in 2020. So extra money that got pushed into the system spiked inflation, but now we're actually below 3% again. That's normal. We just had
Yeah,
some big pops.
we are below what normal inflation rate would be right now. When the Federal Reserve picked 2%, they said over a long period of time, we want 2% to be our target. They had been under 2% inflation for years, and we're trying to get it up to 2%. People were concerned that we were going to be like Japan's economy, where they had deflation and an economy that was declining. So when they set that goal, it was to get inflation up to 2%, not down to 2%. And then when COVID hit and we threw $1 trillion out there in created money, when there was no production, right? So if you think about definition of inflation, too many dollars chasing too few goods. Right? That's one of the definitions. Well, you created a whole bunch of money supply spiked up, and we weren't making anything. I referred to it then as we just poured 5 gallons of gasoline on our barbecue grill. I would expect a little bit of a little bit of a flame. We got a little bit of a flame. Now it's settled back down again. Now we're into normal times, right?
And doubling down on normal times, this is not going to be sound high to some people on this call, but I remember my first mortgage, which we bought a house, I believe it was 97, maybe it was 96, don't remember. My wife would know and kick me, but I believe we were at 10%. We had a 10% mortgage, was our first mortgage. So right now, of course, I've locked in and have a mortgage below 3% on some stuff, and that's great, but that's fictitious and that could not hold. Being at that 5.5 to 6% mortgage rate are great rates. These are great rates. We're just coming off of this unsustainable low rate that's why everything had to come back up.
Yeah, I bought my first house in 1987. I locked in at 10%. I thought I had the greatest thing. I thought I was a rock star. And you're right, long-term average mortgage rates more like 6.5 is kind of a longer term average. Um, so it's really nice when it's under 3. That was the opportunity of a generation right there. And I don't think we'll see it again. And if we do, it'll probably be bad. I mean, bad things are happening in the economy.
Two other points just to kind of reiterate for everyone on here, and we'll talk to everyone individually when we're going through a review, but please call in and if you have any questions. Um, Based on the last conference we were at, and also what you just said with your comments, the likelihood, the probability of a recession in 2026 is basically almost zero. No one's expecting a recession in 2026. So whatever you're hearing on the news, when you hear some talking head saying differently, just turn it off. They're just selling fear. With that said, volatility. I heard volatility, and volatility is going to will happen. We don't know when and at what rate, and at what type of solve that will happen, but it will get better. That's the reason why we meet with you often, clients, and that's the reason why we meet with Clark to make sure we're rebalancing portfolios and putting our portfolios in the right percentage based on your personalities and to ride through those bumpy times. So in last year, we had a period of time in April, so getting close to that time, I remember we had those conversations and people were a little panicky and we were down 20%. but we rode it through, and everyone had a good year last year. 2020, we had, around this time was when all of a sudden that thing that was out there that was overseas was coming around, and maybe something would happen. And the market started to fall around this time. And then it really dropped by the time we were at the end of March. The market dropped 35% peak to trough. And we were with you. And then you returned, and everyone made it through. So point being is there will be volatility. We didn't know COVID was coming. We didn't know in 2008 that there was going to be a financial crisis happening. But that's why we meet with you all the time, and that's why we make sure that your portfolios are rebalanced and aligned correctly. And then we're always working with Clark to correct and move around the edges. Last year, prior to January of last year, so November, December of 2024, we actually dialed up in most of your portfolios, if not all of your portfolios, where it was appropriate, the international exposure. We were underweight international for years because it wasn't paying off. But through what was happening, we started to add more international. International in all of your portfolios outpaced everything else last year. And that's because we're always working for your best interest and looking at your portfolio. Where it was appropriate, we added it and put it in and ramped it up. So we're here. We're always here for you. Why we have these quarterly calls with Glenn is so that you can hear from, I don't want to call you the horse, but we can hear from one of our strategic partners, someone that's been around the block since 1885, as he said, and has seen these different markets. And we have a collaborative call. The amount of times that you guys see Glenn, multiply that by 10, the amount of times that we're working with Glenn and his team, and working on each and every one of your portfolios. We are always here for your questions. Please look for our next quarterly call with Glenn. Invite a friend, invite a family member as well, because, and I'm saying this so sincerely and with a lot of conviction, I want you guys to hear the direct message that's out there in the marketplace right now. The other information that's coming out there is definitely skewed to scare you. That doesn't mean if there's a scary time or a scary event, we're going to handle it head on. We're going to discuss it and understand it, and we'll make adjustments to it. But we're not going to create fear when there's no real reason to have fear. So Jill, I'll turn it back over to you. Oh, you're on mute again? Glenn just said you can't speak. So Glenn, thank you very much.
I let her on.
Thank you, everyone. I'm going to talk over Adam because I never get to do that. So Glenn, thank you for your time. Everyone, thank you for joining us today. Obviously, if there's any questions, if for some reason someone was too shy to put it in the chat or the Q&A, definitely reach out to Adam or myself, and we'll definitely get you those answers. Once it goes through compliance, we're going to put this on our YouTube channel, and then you can send it to your friends or give them the link so they can hear it for themselves. But again, thank you, Glenn, for all the time that you spend with us and our clients. We really appreciate it.
My pleasure. Thank you, everybody, for joining.
Take care. All the best.
Bye-bye.